Welcome, everybody, to another edition of SRT Live. I am your host, Sean, with the Sean Richard Mortgage team here at Guaranteed Rate. Is the Fed going to get too aggressive with their rate hikes? That's our headline for today, and we're going to dive into that along with a lot of other components of what's going on in the housing and economic markets. Thank you so much for joining me. If you're watching in the Powerhouse Real Estate Facebook group, welcome. Make sure that you leave any comments or questions down below. If you're checking us out on the Powerhouse YouTube channel, thanks so much. Make sure you hit that subscribe button so that way you get all the latest updates on economic and housing news. So let's dive into it. Let's take a look at the information that we got today, and we're going to dive right into housing information. So today we got new home sales, which measures signed contracts on new construction. And that came in at an annualized pace of 511,000. Based on with an expectation or a consensus from the economists at 575,000 as an annualized pace. So we came in down on a healthy amount from where we expected. But let's go ahead and dive into this a little bit further. Let's see, that one looks pretty good there. So new home sales came in at 511,000. So that annualized sales pace on the second line right here. Right now, you've got total inventory of 464,000. 511,000 came in at annualized pace. We're down 13% month over month. We are down 30% year over year. So the pace of sales is slowing. That doesn't necessarily mean that the home values are slowing. There's a difference between declining sale pace and declining home value. So this is specifically sales pace. So that 511,000 divided by 12 months gives us a monthly sales pace of 42,600. So based on that, they're reporting about 10.9 months of supply on the market. Now that sounds great, 10.9. Wow, that's amazing. But let's dive into these numbers a little bit more. And you've seen me do this before. So on new homes, only about 45,000 of that 464,000 is actually completed homes. And so if we compare that to our monthly sales pace, we really only have about 1 month of supply on the market right now, because those 45,000 are what's available to buy, to move into. The other 419,000 are still under construction. And as we all know right now, new home construction is TBD across the board. We've got supply chain constraints still. We're seeing that the pace of construction still slow on the new home front. So when those will be available to purchase or move into can be an unknown. And so very, very limited inventory on the new home sales side. So that's the information that we got today. Now, looking back at last week's numbers, we start with the jobless claims. We get these every week on Thursdays, and we get two readings. We get the initial claims, which again is individuals filing for unemployment for the first time. And then we get continuing claims, which is individuals renewing their unemployment claims. So we've been watching this closely to see what the trend is and if we're continuing to trend up or if we see this start to peak and come back down. So the expectation for the week over week initial claims filings was 265,000 after a previous reading of 252,000. It came in just a hair shy of the previous reading, down at 250,000. But this is our second straight reading at or above 250,000. So we're seeing consistently higher levels of jobless claims, of unemployment filings going on right now. Again, something we're going to watch. Continuing claims came in at 1.437 million. Now this is up a little bit from the most recent reading. Last week's reading 1.430 million, but this was on an expectation of 1.438. So we came in just a tad shy of the expectation. Really, you could call that right in line. Now we also got existing home sales for the month of July. And I'm going to go ahead and share this with you as well. So that way you can take a look at this. But existing home sales came in at an annualized pace of 4.81 million. Now, this is down 5.9% month over month, and we're down year over year. So as you can see, both on the new home front and the existing home front, the pace of sales is slowing. Now, some of that very well can be attributed to what we've seen with home prices as well as interest rates. We've seen home prices continually rise, and we've seen interest rates rise significantly from the end of last year to now. Interest rates appear to have peaked in the month of June, and we've seen a little bit of a respite since then. Rates have come down, and we've seen a little bit more activity in most recent months. So we want to watch the new and existing home sales reports over the next couple of months to see if we start to progress in the opposite direction, if we kind of plateau and move the other way. But the median home price is up 10.8% year over year to 404,000. So home prices are sticking in there. Now, as a reminder, median home price, of course, not appreciation. Median home price simply meaning that half of the homes sold above that level and half the homes sold below that level. And that median home price had been rising pretty significantly month over month because we've seen home prices rise dramatically with that appreciation rate. And of course, as you push those home prices higher, then the median home price is going to rise as well. As you can see here, we've got a quick breakdown of the percentage of buyers in the market. First-time home buyers making up 29%, cash buyers making up 24%, and investors making up 14%. But what I really want to dive into is the inventory. Inventory, so critical for us. If you're a real estate agent, obviously you want to be able to speak to this for your clients, for your prospective buyers, those who are maybe sitting on the sidelines and debating whether to get back into the market. If you're a home buyer, you want to understand what's going on with inventory so that way you have a better grasp on the market and how to approach it. So inventory is up slightly, 1.31 million, up from 1.26 last month. We are starting to see a slowdown of inventory increases. Now, that tends to happen this time of year. We tend to see inventory pick up at the beginning of summer. And as summer wanes, we start to see inventory subside a little bit. And this is year over year, nothing new. So a normal market is about 6 months of supply. We're sitting at about 3.3 months right now. However, that is the surface number. And so let's, again, like we did with new home sales, let's break down existing home sales. So of that 1.31 million homes for sale, 747 are active listings. That means the other 43% are under contract in some form or fashion, pending, contingent, any of those. And so 747 active listings means we've got much smaller amount of inventory. We've actually got less than 2 months of supply of inventory when you start looking at actual homes that are available on the market for purchase. So we still have relatively low supply, even though supply has picked up some in the past couple of months now. So supply staying relatively low and demand staying relatively robust. So I would say that we do have a relatively healthy market. We don't have the extreme seller's market that we had for the first probably 7 months of the year, but we're seeing a more normalization. I like to call it a softening market, but we still have low inventory and relatively robust demand. So we got those existing home sales last week as well. And then we also had the Fed meeting minutes. And this is key because although the Fed meeting gives us a lot of insight, we hear from Jerome Powell after the meeting minutes gives us a little bit more detail into the inner workings, inner thoughts of the Fed and how they plan to approach the economic levers that they pull going forward. So the notations that we got from the meeting minutes is that the majority of the Fed believes that inflation is still too high and they want to aggressively continue to attack inflation to get that back down to their target 2% rate. So it's very likely that we're going to see at least a 50 basis points or a 0.5% increase to the Fed funds rate at their September meeting. And if we do see that, that means we'll have seen a 2% increase to the Fed funds rate in the most recent 3 Fed meetings. Now, if you're a consumer watching this, just as a reminder, the Fed funds rate is not something that directly impacts mortgage rates. The Fed increasing the Fed funds rate is designed to combat inflation. Inflation is the enemy of mortgage rates. So inflation has been running extremely hot, and that's been pushing rates higher. So with the Fed increasing the Fed funds rate with the idea of bringing inflation down, as inflation starts to subside, we should start to see mortgage rates subside as well. Through the end of this year and into next year, we're likely going to see some small declines in mortgage rates. I personally think we're going to see the biggest declines towards the end of Q2 of next year and into Q3. But if you're a home buyer, don't pass up the equity building between now and then. Refinances are a thing. Take advantage of the appreciation that we're still continuing to see in the housing market, and then refinance to get that savings later on. All right. So we got some insight into the Fed meeting from those Fed funds from the Fed minutes. Now, looking ahead to this week, we've got a couple of big things. One, tomorrow we get pending home sales. So we're going to keep an eye on that. We like to see what the inventory is doing, the pace of sales. We want to watch all of those reports, new homes, existing homes, and pending home sales. On Thursday, as usual, we get jobless claims, unemployment claims, and then we also get the second reading for Q2 GDP. First reading came in at a negative 0.9. We've got another reading coming up Thursday. And then next month, September, we'll get the third and final reading for Q2 GDP. As a reminder, GDP, if we see two consecutive quarters of negative GDP, that's the old school traditional definition of a recession. In fact, we have never in the history of our economy had two consecutive quarters of negative GDP without a recession. So very, very strong indicator. Now, full disclosure, past performance is not indicative of future returns, meaning, what has happened in the past does not mean we are doomed to repeat it, but it's a very strong indicator. So we want to watch out for that on Thursday, see where that comes in. The expectation is that we're going to see a negative 0.8 reading on that second GDP reading. And then on Friday is the big day this week. We get PCE, which is personal consumption expenditure. This is an inflationary report, and it's actually the Fed's favorite measure of inflation. So the Fed's going to be paying attention. We need to be paying attention to that as well. And then starting tomorrow and running through Friday is the Jackson Hole Symposium. And this is a get together of economic minds, of Fed members. And this is going to be a potential market mover for any commentary that comes out. So on Friday, after the Jackson Hole Symposium concludes, we're going to hear from Jerome Powell with his testimony. Anytime Jerome Powell opens his mouth, it has the ability to move markets. And so we're going to want to be on guard for that. All right, so let's end today talking about what we're watching going forward. And the first thing is housing inventory. As I mentioned, housing inventory is still relatively tight. We have below average months of supply. And although demand has softened a little bit, we're still seeing demand relatively robust. Home prices are hanging in there. We've seen some very recent home appreciation reports from Case-Shiller and FHFA, Federal Housing Finance Agency, showing extremely robust appreciation. We are going to want to keep an eye on those reports month over month to see the trend. Have we peaked and we're starting to decline? And is that trend going to continue? But for now, we're seeing still concrete appreciation in housing, especially here in the Dallas-Fort Worth Metroplex. Second is we're going to keep an eye on the Jackson Hole Symposium. The comments coming out of there, as I mentioned, are going to be potentially market moving, and especially hearing from Jerome Powell on Friday, that's going to give us a lot more insight into how the Fed is looking at the economy moving forward and combating inflation. And then lastly, we're keeping an eye on employment and more specifically, unemployment. We've got jobless claims every Thursday. We're always keeping an eye on the trend. We've seen that trend tick up over the past couple of months, going from low 200,000s week over week, upwards of most recently 2 consecutive readings of 250,000 and more. And we're continuing to see layoff reports in the news, large companies laying off workers. That's going to filter into those jobless claims numbers here in the coming weeks and months. And we'll want to see where that next jobs report, the Board of Labor and Statistics jobs report comes out, as well as the corresponding unemployment rate on the next reading. So those are three things that we're watching for going forward to get a really good grasp, not only on the economy, but also on our housing market. If you have questions, comments, don't hesitate to reach out to me. You can always reach me right here at the number, and then you can always leave comments or questions below the video. Happy to respond to those. My team and I are here to take care of all of your home financing needs, whether you're looking to purchase or refinance. We want to have that conversation with you and create a better mortgage conversation. All right. Well, gang, I appreciate you joining me on this episode of SRT Live. As always, I am your host, Sean, with the Sean Richard Mortgage team here at Guaranteed Rate. Until next week, have an incredible rest of your week. Take care.